Welcome to another edition of Money Ideas. We're going to take a look at 4 charts that changed the way I think about financial markets. Starting off with news that Saudi Arabia is the wealthiest country in the region. You're going to say, well, I actually knew that already. Well, it's a bit more complicated than that because new data out from BCG adds important color to the story. You look at the numbers, Saudi Arabia's total net wealth grew by 1% on the year to $3.7 trillion in 2024. Then, second place, the United Arab Emirates, and they are catching up fast. The way they did the calculation is by combining the value of assets minus liabilities, and this is for individuals, and those are up almost 10% to $3.1 trillion. If the United Arab Emirates continues at this pace, then within probably about a year or two, they're going to be able to close the gap to Saudi Arabia. And they've been doing so much across the region to try and get more investment from abroad, right? So now you have the numbers that really tell that story and to what extent it has been a success. The measure is financial wealth and real assets, right? So the folks at the Boston Consulting Group, which is, of course, the company well known for its advisory services, they added in that equation things like liquid investable assets, so equities, bonds, currencies, deposits, life insurance, even pensions. But the thing is that they did not really specify another important indicator, was the GDP per capita, right? Because if you would take the total wealth in Saudi Arabia and divide that by the population, it would be a lot less, and the ranking would be quite different. And Qatar would be leading the charge there. But in this ranking, it is Saudi Arabia at the very top. Qatar's total net wealth coming in at $765 billion. That's up about 2% from the previous year. Kuwait coming in at a net wealth of $538 billion. And Oman and Bahrain at the bottom with $300 billion and $160 billion, respectively. And it really proves one thing to me, and it's that all the improvements that are being done to become global financial centers are paying off, regardless of whether that is in Riyadh, Dubai or Abu Dhabi, or Doha. The next chart I find super interesting, and it is a closer look at what happened during the dot-com bubble, right? Especially with all the debate currently about valuations. And basically, technology stocks sank, right? The Nasdaq lost nearly 80% from peak to trough. Let's zoom in on the chart. But here's what many investors forget, that the damage was initially contained. Outside of tech, the market kept moving higher. And in this latest research paper by Peter Berzin of BCA Research, non-technology stocks actually continued to move higher and higher, even after the bubble burst, actually a full year after the bubble got pricked. And that is just wild. Capital didn't flee equities either, actually. It just rotated. Investors moved into things like industrials, financials, energy, and consumer names. So there was this belief that the real economy would remain insulated from the excesses of Silicon Valley. And that assumption held until it didn't, because by 2001, broader market rolls over, diversification stops working as the economy enters a recession. And you fast forward to today, the parallels are getting harder to ignore. Market leadership has been exceptionally concentrated. Remember the conversation we had with the Motorrad. And when I asked him whether we are in a bubble or not, he said, look, the valuations are rich for sure. But he didn't subscribe to the idea that we are in a bubble. But maybe we are at a verge of a great rotation, just like what happened during the dot-com bubble. Could capital flow out of some of the high-tech, high-growth names into lagging sectors like industrials, materials, financials, without necessarily triggering a broader market downturn? That is worrying, right? History doesn't necessarily repeat itself, but it does often rhyme, right? And if the late 1990s taught us anything, it's that the first crack in the market doesn't always come with a crash. Let us know what you think about the subject. I'd love to hear from you in the comments below. Let's take a look at this third chart now from Richest and take a look at what works in terms of hedging against inflation over the last few decades. And what they zoomed in on specifically is the different assets, right? And then inflation by decade, bonds by decade, and stocks by decade. And you can see that we had higher than average inflation. That's not hurt stocks, right, since the 2020s. Let's roll back a little bit, shall we? And yeah, market did all right in terms of managing relatively high inflation in the 1980s as well. Inflation averaged 5% during that decade, and the stock market did 17% annually. But what if we pulled back even a bit further? The 1970s is where the nightmare scenario comes through in terms of where sky-high inflation gets you and real returns were negative for the whole decade. I want to add a bit more meat on the bone there because inflation didn't explode overnight in the 1970s, right? It built gradually through the 1960s. You had heavy government spending from the Vietnam War. The Fed kept monetary policy very loose. And then you had the shocks. 1971, President Nixon ends the gold standard, and that really shook up the dollar. And then you had a wage and price control as well that was applied, and they tried to mask inflation, right? They tried to pretend like it didn't exist. And instead of facing the problem head on, the sugar coating made things a lot worse. And then you had a real catalyst that came after with the 1973 Arab oil embargo that sent oil prices soaring. And we remember the vivid images of cars, hundreds of them lined outside of petrol stations, either struggling with price or struggling to get any fuel at all. Absolutely incredible. And that was followed by a second oil shock to make things even worse by the end of the decade. And then suddenly you had this toxic combination between low growth, high unemployment, and high inflation. Stagflation that really weighed on consumer sentiment. There was also this loss of credibility because businesses and consumers began to expect inflation. And so they took that into consideration, not just into their day-to-day decisions, but also in terms of what the longer-term horizon is likely to look at. And that kind of feedback loop is really hard to crack. And it wasn't until Paul Volcker, the Fed chair in the early 1980s, came in and raised interest rates aggressively. Yes, he unleashed the painful recession, but finally inflation was brought back under control. And the lesson was that once inflation expectations become unanchored, restoring stability requires significant economic pain. And all of this gets us back to the different eras in terms of the Richest chart and how asset classes performed in terms of trying to hedge against inflation. And there's no simple formula here is what they write. If you're a glass half empty person, you look at the chart and point to the fact that 2 of the past 8 decades have seen stocks fall behind the inflation rate for a real lost decade. And that hurts. The glass half full version is that the stock market has compounded at 11.7% per year since 1950. Take away the 3.5% average inflation rate in that time, it gives you a real return of 8.2% per year. These days, it's hard to find a single minute where somebody's not talking about AI. But this time, I want to zoom out a little bit just for context in terms of the AI revolution. And it's really, really young. And you think about the public inflection point when ChatGPT was released. We're barely 2.5 years into what many are calling a once-in-a-generation shift. And despite all of that, it's a very short window where we've seen dramatic swings. Goldman Sachs points this out through Jim Schneider, and they say, look, the leadership has changed in a very rapid fashion, right? The early enthusiasm was centered on large language models at massive scale training. And then the attention shifted to things like efficiency and open source alternatives. And then more recently, the focus has switched to what they call multimodal systems that are specialized on enterprise use cases. And the leaderboard is based on the benchmarks that Chatbot Arena puts together, which is a crowdsourced, randomized battle platform for large language models. So when we think about ranking things like Gemini or ChatGPT for certain functions, this is what a lot of people lean on to get that perspective. And the rotation in leadership matters, right? Because markets tend to price technological revolutions as if the leadership is permanent, but it's not. And history confirms that. In the early days of the internet, It was about search, hardware, networking, right? Had its own moments as well, but often long before the ultimate winners emerged. So what we're seeing now is a landscape where it's less about who's winning and losing and more about a market that is constantly recalibrating expectations. If capabilities evolve, then the capital is going to shift accordingly. And the takeaway being that transformative technology doesn't necessarily always move in a straight line. The AI trade is not a single bet. It's a sequence of phases, and 2.5 years in, we're still very early on in the process. And that's all we have for this edition of Money Ideas, a look at the week's charts that truly matter. If you want next week's charts the moment they drop, hit the subscribe button. We'd always love to hear from you. See you next time.